Hello and welcome to this podcast. In this series of podcasts, we've been working through the General Deduction formula in Section 11A. Here's Section 11A, and in this podcast we're going to have a look at what it means to incur expenditure or loss in the production of income, which is one of the requirements of Section 11A. So, in the case of Nigel, there was the question of whether the expenditure incurred had to actually have resulted in income. And in that example, the court said no, it only has to be incurred for the purpose of earning income. Whether income actually resulted or not didn't actually determine whether the amount was deductible. In the case of Nigel, they had claimed a deduction for insurance costs, short-term insurance. And SARS had tried to prohibit the deduction on the basis that they hadn't claimed against their insurance, so there was no income resulting from the premiums. The court said it has to be for the purpose of earning income, not that there actually has to have been income. In the case of Concentra, the court decided that you had to claim expenditure in the year that it is incurred. You can't claim it later if you don't claim it in the year it's incurred. So in the case of Concentra, there was a director and the company had been newly formed. The director had incurred costs on behalf of the company, and the company had asked him not to claim the costs back from the company in the current year because they didn't have any income and they didn't want to show a loss in their first year. And so he withheld his claim and he claimed it in a later year when the company had more income, and the company tried to deduct the expenditure in that year. The court said that it couldn't deduct it in that year, it had to have deducted it in the year it was incurred. So when is expenditure in the production of income? Well, for some expenditure it might be quite obvious that it's in the production of income. You pay your employees, you buy your trading stock, those kind of things. It's fairly easy to link those to income. But gradually, I suppose, expenditure might get further and further removed from income. And the question is, when is it for the purpose of earning income? So there's three cases that really build one on top of the other in terms of how we would analyze this. The first was PE electric tramways. PE electric tramways ran a tram company, and one of their drivers had been killed in an accident. And they had to pay compensation to the family of the driver, and the question was whether that compensation was deductible or not, and specifically whether that compensation was in the production of income. Because obviously no income flowed directly from the payment of the compensation itself. And in that case the court said that first of all, expenditure itself doesn't result in income. What results in income is actions. You render a service, you provide trading stock. That's what delivers your income. What you have to determine is what is the action that generates your income, and how closely is the current expenditure linked to that action. And in this example they said the action that generates P electric tramways as income is the employment of drivers. The question was then how closely linked is the payment of compensation to the employment of drivers. And in the current scenario they said that there was a close enough link. Trams were inherently dangerous, and so it was quite likely that you would incur expenditure for compensation if you employed drivers. So in PE electric tramways the question was how closely is the expenditure linked to your income earning actions. In Joffe & Co. they then tested what does this closely enough requirement mean, and they came up with the requirement that it must be an inevitable concomitant of your income earning operations. Joffe & Co. were in the business of construction, and the question was how closely linked is the possibility of an accident to the construction industry. And they said it needs to be an inevitable concomitant. Concomitant means it comes with. So the expense or the risk of the expense has to come with the income earning operations. And in Rendell they took it one further because they said the problem with Joffe is they've said that the expenditure must be an inevitable concomitant. But that would then exclude any expenditure that is based on risk, because if it must be inevitable, then that kind of precludes the possibility of risk. And in Rendell they said it's actually the risk that must be closely connected to the taxpayer's business operations, or it must be the risk that is an inevitable concomitant of the business operations. So the expenditure may or may not occur, and you might be able to avoid the expenditure itself, but the risk is always there. So I suppose if we wanted to phrase it in a question, we would say, does the risk of incurring this expenditure always exist in this kind of business? So let's look at some examples which hopefully will illustrate this. So are the following in the production of income? Advertising expenses in 2012 for a product that was expected to go on sale in 2013 but was subsequently cancelled. Is that in the production of income? Well, yes, sub Nigel would say that it doesn't have to have actually resulted in income, it just has to be for the purpose of earning income. So that one would be fine. Second example, a settlement paid by a coffee shop to a customer that was burnt by too hot coffee. Well, we need to go to the test that was started in PE electric tramways and finalized in Rendell and say, is the risk of this expenditure being incurred an inevitable concomitant of owning a coffee shop? And I think we could make a good argument for saying yes. You might be able to avoid the event happening, but you can't avoid the risk being there. If you own a coffee shop, there is always the risk that someone could be burnt by hot coffee. But compare that to the next example. A settlement paid by a professional sportsman to an opponent for an unfortunate remark made at an interview when he was drunk. The question we've got to ask is the possibility of being sued by an opponent an inevitable concomitant of being a professional sportsman? And given the context, I think you could say, no, this is not an inevitable risk of being a sportsman, getting drunk and making an unfortunate remark and getting sued. It's quite possible that you could be a sportsman and not have this risk present. So I think in this example we would say this is not in the production of income. Final example, the payment of a non-contractual retirement bonus to a faithful employee. Is that in the production of income? Well, if it was contractual, then clearly it is, because that is part of the contract with the employee and the employee has provided services on the basis of that contract. If it was non-contractual, then case law tells us that it would need to be the regular practice of the employer to pay this kind of bonus. In other words, there would need to be a realistic expectation for the existing employees that they would receive this kind of bonus or similar, and that would motivate them to work harder while they're employed. That comes from the case of provider, P-R-O-V-I-D-E-R. And the point that they were making was that once this person retires, they've left. Paying them more money doesn't earn you any more income unless it encourages your existing employees to work harder. The result that earns more income is what the existing employees will do in order to secure themselves the bonus in the future. But if it is not contractual and it is not the regular practice of the employer, then case law again tells us that that would not be deductible. That was decided in the case of W.F. Johnston. So non-contractual must at least be the regular practice of the employer and create a reasonable expectation with the existing employees. So that's a little bit more on the requirement for expenditure to be in the production of income, and we will look in the next podcast at what it means to be not of a capital nature. Thanks for watching.